Hello, Matthias.
Hi, Kisa. Hi, how are you?
I'm good. I'm good. You found a nice place to sit?
Yes, I did. As I told you, I'm currently in Paris, so
Yeah.
I'm celebrating my friend. But I mean,
My apologies.
no problem. It wasn't. Actually, didn't think about it before we spoke. But I'm in this office now, so it's good.
Excellent. Excellent. So, uh, first of all, thank you, Matthias, again for accepting my invite. You are a very popular person in Pakistan, especially the financial markets. They follow you, they admire your work, and it was on my our agenda to have a conversation with you to hear your views about the frontier markets as well as that of Pakistan. So, just for the audience, Mattias Martinsson is Chief Investment Officer and founding partner and at Tundra founder, and I think a lot of you know already. And normally we do this conversation in Urdu, but we have a little bit um, challenge here. I hope like Bhai and Sarmaaya team, they will help us on taking some notes and sharing with all of you. So Matthias, thank you very much again. Let's start. So my first question is obviously about the name and the logo. I really love it. And I also work for a Swedish company. And there is always something behind the names in Sweden, historical reasons. So if we can start with that.
Absolutely. Thank you, Kisa, for inviting me. I appreciate that. And I think more pods like yourselves are needed in Pakistan in order to improve the financial literacy and help people with their investment decisions. And I'm happy to participate in that. If we look at Tundra, the name comes from which is originally a Russian word. It goes across the globe, and we say that it's the border between what is already known and what is yet to be discovered. And I think that symbolizes a lot what Tundra has done with the markets that we work with, and I think maybe particularly Pakistan.
Excellent, excellent. Thank you very much, Matthias. And my second question was if you can a little bit briefly explain what Tundra does, like investment products, and how can people invest through you, especially from Pakistan.
Sure. So we have only one fund that we manage today, which is a frontier markets fund, and every fund manager has their definition of frontier markets. For Tundra, we focus on markets that are either lower middle income countries or low income countries. So that's basically all countries, potentially all countries in the world with a GDP per capita of $4,000 or less. These markets today constitute approximately 50% of the world's population. But given their demographics, they're expected to be approximately 67% in 50 years. So we believe this part of the world and countries, as an example, Pakistan, has a lot of growth ahead of them. And our idea is to kind of be the complementing fund for investors who are looking for exposure to emerging markets, but also want a little bit of the smaller markets that sometimes are more exciting. So that is the fund. The product in itself, this is a traditional UCITS fund. So basically, it abides with the regulation of the European Union. It's open to any investor, except if you're domiciled in the US, which is not allowed. But we only market the fund in Scandinavia and in Switzerland towards retail investors. So if investors want to know more about the fund, they can just visit our website and have a look. Most banks, and especially the global banks, can provide access to the fund if an investor wants to. But If you're a very small investor, it might be difficult. So everyone has to do their own due diligence on that.
Sure. And what is behind this special love of emerging markets is understandable, but what about frontier markets? Do these not bring more risks? Of course, more risk and more returns. But what's your philosophy about being the expert of frontier markets?
Well, I think I got my passion for frontier markets as I actually started my career with Russia in the mid 90s. And Russia at that time was a huge potential equity market, but very less developed. And I think the fact that I was one of a handful persons in Scandinavia that got to know that market early and then could use that to our advantage when a lot of new global investors were looking at it. That kind of I think the lesson from that is that it can be worth knowing a lot about the market that very few people know very much about. So I think that's the original reason why we started with the company like Tundra. If we look at the individual countries in there, they are all very risky. So Pakistan is a super risky country to invest in. Sri Lanka is a very risky country. Bangladesh, etc. Vietnam and all of those markets. But the fact is that they are many times not driven by the same factors. And the reason for that is that the majority of investors in these markets are local investors. And local investors, they care mostly about the problems on the ground in their own countries. Take Pakistan as an example currently with the discussions on potential debt restructuring, the political situation. That is not something that the local investors in Vietnam are discussing right now. So that means that they move in different phases, and that if you own 8 to 10 of these markets in a fund, that means that the deviations, the daily deviations, are even out a bit, and that means that a frontier markets fund over time is normally less risky than a bigger emerging markets fund.
Understand. And regarding the sustainability fund of Tundra, do you think that companies in frontier markets really pay attention to the sustainability or ESG goals these days? We have a very good example in Pakistan where you are also invested Interloop. They are kind of example for many companies. But what's your like a view of the overall markets?
Yeah, I think the first thing to say about sustainability is that it requires that you take a very holistic approach, meaning that you cannot only focus on environmental or social or governance issues. The core of our sustainability philosophy is that we want to invest in companies that have a positive impact on the societies where they operate. And that's not altruistic approach at all. It's not that we're very nice people. It's just we believe that if you have a positive impact on the society where you operate, that means that the local politicians want you to succeed. That in turn means that you are at less risk of having new unexpected taxes or that the police is knocking on your door. So companies that can make the local politicians look good, we believe have a higher chance of succeeding. Because my experience from these almost 27 years investing in these markets right now is that you have two major risks that you need to take into consideration. The first one is corporate governance risk, basically the risk of dishonest owners or management. And the second is state governance risk, the risks of sudden new regulations or changes that can severely impact your business model. But for companies who positively impact the societies where they operate, those risks are lower, and that means that it's a better investment for us.
Thank you, Mattias. Mattias, I see you have a very broad-based access to the markets in all emerging frontier markets. If you don't mind sharing your criteria, how do you scan the markets? How do you pick the winners? If you like to share some stories, those who follow you on Twitter, we know that very long time back, you used to talk about system in Pakistan,
Mm,
and that has been a success story because market was bearish and system was bullish. So, how do you scan the markets? How you pick the good winners? And if you like to share for us, like retail investors, how to do that?
sure. I think the first thing that you need to accept is that you will not be able to find the best stories, or not all of them. If you find a few good stories in a fund, that can be enough to have a successful performance. So what we do first of all is that we need to limit our universe. So for us, for example, our fund, as opposed to many other frontier funds, we don't look in 20 markets at the same time, but normally it's maybe 7 to 10, where the majority of our investments are in maybe 4 or 5 markets. That means that we have a smaller universe and we have more time to spend on each market. Then after that, if you look at the 8 to 10 largest markets where we have invested, there are approximately 4,000 companies. The fund has now been around for approximately 10 years. During this time, we have invested in, I think, slightly less than 150 companies, which means a few percentages of these equity markets. And what we look for in a new investment is basically is 3 things. First of all, we do a very careful due diligence on the governance side, well, who owns the company and which management they have in place. The second thing we look at is that we want the company to be involved in a business which will, in the future, constitute a larger share of the economy than it does today. We call that structural growth. So if you have a market that which GDP over time grows 4%, and we have a company that we believe can grow 10, that's an example of structural growth. The third point is coming back to the sustainability. And again, that's simply from an investment perspective, that we want companies who have a positive impact on society, because the state governance risk is lower. You mentioned systems, which I think is a great example, because many times the fact is that since we launched the fund, the Pakistan equity market is down approximately 60% in US dollars. But Pakistan, in our fund, the companies that we owned, has still been the single most important contribution to the fund's absolute performance. So our absolutely best investments are in Pakistan. And systems is a great example, because there you have a company that is majorly owned by its employees, that are involved in a sector which is subject to structural growth, with the youth, the well-educated youth coming into markets and increasing access to internet. And the third, of course, is that what System does, it exports more than 80% of its revenue, which is exactly in line with what the state wants. It's not only that it provides exports to Pakistan, but it's also high value added exports. So it educates people, it educates new engineers, new software engineers, and it creates FX currency back into Pakistan. So Systems, just as you mentioned, is a great example of a company that we still like very, very much. It's one of the largest holdings in the fund.
Thank you, Matthias. Matthias, my next question is like it's very known in Pakistan that whenever market closes in the evening, a lot of experts will show up and start talking about how much inflows from foreigners came and how many outflows from foreigners. And it's quite common that since 2017, many foreigners have been left. They are constantly exiting Pakistan market.
Mm.
However, you are still invested. So, what's your view on that?
Well, I think that foreign interest goes in cycles. My first year in Russia, the market from 96 to the peak of 97, the market went up by more than 100%, and you felt like you were a superstar. The following 15 months, the equity market fell 97%, and that's 97%. So basically, it was eliminated. And at that time, everyone was talking about that the foreigners will never return to this market. It will, but fact is that foreign investors, they have a very short memory. Pakistan's problems of recent years is, of course, that you have decades of structural issues with the constantly changing governments and maybe not the best expansion of civil servants. But you also should recall that you had a number of disasters in recent years, which started with the emerging markets crisis in 2018. Then you had COVID that hit all poor countries almost equally hard. And then this was followed, of course, by the booming commodity prices following the opening up after COVID, and then, of course, Russia-Ukraine crisis. So I think that Pakistan's situation today is, of course, is desperate. It's very, very poor. But what we need to think about is what are the current valuations, and how does the companies that we have invested in, how can they survive this environment? Because if they can survive this environment, and given the current valuations, I think it's going to be a very good 2 to 3 year investment. But and that's important to say, that you need to respect the current uncertainties. I think we need clarity on the political front before foreign investors are willing to re-enter in a more significant scale. But you have elections this autumn, which hopefully will happen. So it's not that far until foreign investors can start looking at the market again. So don't be too pessimistic.
Sure. I'm also an overseas Mattias, so I started investing and learning since 2021, Jan 2021. And this there was a time like rupee was at 65, 70, and I made a lot of my friends to invest in Pakistan, and we had a view that that currency would not further depreciate. But today it stands like 100 rupees further down. So you have also mentioned that 60% markets has gone down in dollar terms. So how do you manage with this unstoppable depreciation, and what would you say? Because somebody asked me to ask you what was or what your dollar-based returns has been in 20 years, during last 20 years.
Well, I think first of all, if we look at if we take our exposure today, and this is just to give you an example. So we have 16% of the fund in Pakistan. Half of that is systems, which basically, as you know, is a foreign currency denominated revenue company. Then we have 2 banks. The second biggest position is a company called Misan Bank, which we think is a great long-term story, which also did decently well last year, despite the circumstances. So most of the majority of our investments in the fund are companies that do decently well in a situation like this. They are affected by the multiple contraction, which always happens when investors are nervous. But we don't really care about multiple contraction as long as the companies are still growing, and we believe that there is a logic for them to continue their long-term journey. I'm not concerned about that. Because all markets go through crisis, and some companies handle those crises better. And if you try to focus on those companies, you will not be 100% correct. We also have examples of very poor investments that we should have waited with investing. But if you look at the overall picture, and you adapt your investments to the environment where you invest, then you shouldn't be too concerned. It's a long-term game, and we had decent returns also in the recent years.
Excellent. Asad, you have written 2 questions. I will give you the floor as a speaker, so please ask yourself. And some has requested the mic. Give me a few more minutes, and then I will open the floor for the question and answer. Mattias, the biggest fear which the Pakistani market participants has been going through recently is the fear of default, and you have practically experienced it in Sri Lanka. So, what's your advice to Pakistani investors who are really very frightened with this fear of default? So, if you would like to share, like, how did you manage the Sri Lankan situation, and what would be your advice to me and the other retail investors who are really very frightened of this default fear?
Yeah. Well, I think Sri Lanka was a very, very special example. Whatever will happen in Pakistan will not be, or it should not be like the Sri Lanka case, because that requires a complete mismanagement even from here. So what Sri Lanka did, first of all, that their foreign denominated debt was mainly in commercial debt. They have a much, much higher share of commercial debt. I think it was around 40% when their problem started. And the new government that was in place refused to let the currency depreciate and instead introduced capital controls. So from June 2021, you could basically not transfer money out of Sri Lanka anymore, even for equity investors. So they were basically gambling on COVID disappearing and that there will be no further damage on commodity prices. And then when the Russia-Ukraine crisis hit, their FX reserves were down at zero. So the situation that unfolded in Sri Lanka meant that they could not even afford to buy medicines or and absolutely no fuel. So the economy went to a complete standstill. And that's something I always said was very unlikely that Pakistan would experience. I think it's very possible that Pakistan undertakes some sort of debt restructuring. I think that's a theme that we will see in many less developed economies over the recent years. But given that Pakistan has a much higher share of bilateral and multilateral debt, I don't think it's such a dramatic event that some investors claim it will be. And once it's done, as you can see now in Sri Lanka, which is approaching the end of it, it's a big relief for the economy, because you need to consider that what the bond investors' pain is not equity investors' pain, but it's rather their benefit. So if you can manage to find a decent form of restructuring, which I think Pakistan definitely can, I don't see it as a very dramatic event for equity markets. And if we take the Sri Lankan experience, which is just recent, Sri Lanka has actually done better than Pakistan now. And after the recent events, when China also said that they would support the debt restructuring, the currency appreciated by more than 10% in just a week's time. So the hardest part of a situation like this is before the event actually occurs. That's always the case, because peak fear is before what you are afraid of actually happens. Once it has happened, what should you then be afraid of? Because then then you can look forward again. So I don't. Short term, it means that anything can happen as long as the uncertainty remains. But once it's done, I'm sure that the market will find a footing much higher than it is currently.
Yeah, thank you, Matthias. I had done some sessions with Amar Yassin a couple of weeks back, and it was purely about the discussion of default. So we believe it will not happen, God forbid, but if happens, because we should always be ready with the risk management, and there is always a first time. So the discussion was that if it happens, a lot of examples were shared, like Iran, Argentina, and other countries. The markets bounce back very nicely. So the advice was that if it happens, the best place to invest your extra money is the financial markets. I mean, the equity market. So do you agree with that?
I think so too, because you should recall that I think that it's obviously difficult because people have different risk perspectives. If you simply look at the risk of your stock moving lower, I can't really help you with that, because yes, it might very well do that in the short term, but you should recall that all assets have a real value. So if you are a textile manufacturer, for example. You bought your equipment from Germany or wherever it came. That, yes, and you book that in rupees, but the value in US dollars is still going to be the same. So it's equities. Most equities are real assets that their value is maintained. Equity markets might lower its value short term, but it always bounces back because the true value is a real value. So you should respect currency changes, and you can think about how you can position your fund accordingly or your investment, but you should not be. I think the fear is a little bit overdone, and that goes not only for Pakistan but most of our markets.
Thank you, Mattias. A lot of colleagues have requested for Mike, so I'll make it the last question now. I see that Tundra Fund is quite bullish on Pakistan, where Pakistanis unfortunately are bearish due to obvious reasons. So, what's your advice for, again, the retail investors, and what companies, sectors are going forward on your watch list?
Well, I think the most, if we look at single investment, I think the most honest in answer from me would be to explain our biggest holdings in Pakistan. And that is not inside information because you can find it in our monthly letters every month. Our two biggest investments are Systems Limited and Misan Bank. Those are two high quality names that I'm comfortable with, and which I think any investor can have a look at. Generally, when in terms of investment, for the normal investor, the retail investor, you should never gamble when you invest, but you should invest gradually. So I think the best idea many times is that if you're thinking about entering a market that is currently very cheap but is in crisis, that you do that gradually. So if you had 1,000 rupees that you wanted to invest, so invest 200 now, wait 2 months, and then you do another 200. Do it gradually, and I think that based on the value that we see in the markets, that your returns over the next decades, I think it will be one of the better ones that you will find anywhere in the world. From which level the market recovers, that's a harder question, because that is about market psychology, etc. But you should definitely start investing.
Thank you, Mattias. Let's go ahead with the question of Shaz. Shaz?
Okay.
Okay.
May I?
Yeah, please
Okay,
go
thank
ahead.
you. First of all, let me offer my words of appreciation to Khizar and Sarmaaya Financials to give this an opportunity to interact with Mattias. And of course, before I begin, let me just take a moment to apologize in advance to Mattias if I mispronounce his name, because I'm a little bit, doubtful about.
No, it's very good.
I mean,
it's
come
good.
on, even Palit Kolo had trouble with it, and now it has become the hottest topic on social media, actually. So coming to the questions, I would particularly refer to rising interest rate scenario, especially in the backdrop of recent Jerome Powell's recent statement that interest rate would go up beyond expectations. So my questions are basically in three variations, but they are actually relating to the same interest rate scenario and its impact on the stock market. First, I would like to know that how do this rising interest rate affect different sectors of the economy, and which sectors are more vulnerable to interest rates increase? And secondly, how do these impact the valuation of stocks, and what factors should investor consider when assessing the impact of interest rate changes on stock prices, especially these emerging markets that you deal with it?
Absolutely. So I think I would first say that normally we look 8 to 10 years ahead. So that basically means that we don't know horizons. But let me anyway answer your first questions in terms of which sectors will do better. In a market environment like this, and you have inflation at above 30%, you have interest rates that might still go higher. There are obviously two kinds of stocks that you can probably do decently well in. The first one is banks, which benefit from the higher interest rate environment, and that's kind of a global phenomenon. The second one is, of course, harder because there's not so many companies, but the very high interest rate environment implies that the currency will continue to depreciate. So that means that exporting companies might benefit from that. I have two examples in our portfolio, which is systems, but also, as Kisar earlier mentioned, Interloop, which we also own. Exporting companies and banks are likely to do better in the short term. And sorry, your second question was... can you repeat that for me?
Sorry, he's not on the panel now. Maybe we can move to the next question. Asad Murani has asked through tweet because his battery is low. How do you find potentially high growth companies whose revenues are not in USDs? For example, Mizan Bank.
Well, I think we're very quality focused. We obviously, when we screen for companies, and you should recall that Pakistan we've followed now for that is long since before Tundra was started. So it's basically since 2005. We always had a selection of companies which we felt where we were confident enough in the owners, and where we liked the business which they undertook. If we take Mizan Bank, that's what I really liked about them when we first invested was the fact that the state had a very clear ambition to increase Islamic assets in the banking industry, and they still do. That means that they were less likely to be impacted by new regulation, which turned out to be true with the interest rate floor, etc. That does not apply to Islamic. What I liked about them was the fact that I think that almost all Pakistanis that I've met want to be good Muslims. They want to carry on their lives in a way that is aligned with their faith. But they are also very picky in terms of what services they want and what quality of life they want. And what I concluded with Mizan Bank was that they gave these investors a chance to be good Muslims, but not sacrifice the level of service that they got. And I think that was a very interesting franchise for a company to have. So we didn't really see Mizan as a traditional bank, but we rather saw it more as almost a private banking franchise with a very strong competitive advantage in terms of the quality of its delivery. So that's... but again, in the equity market, you have around 500 companies, and you have maybe 100 of them where liquidity is enough for us to trade in. And after that, it's about quality, long-term growth aspects, which for us always starts with looking at the history. We very seldom buy turnaround stories, but we buy companies that historically have already been successful, who have strong fundamental performance, but also whose share prices are aligned with that fundamental performance. So we want basically a simple way to explain it is that, for example, we own Interloop instead of other textile companies. And if you look at the share price of Interloop, it has significantly outperformed most other textile companies. So, and I think a good share price performance is also the easiest sign of corporate governance. So if I think if I would translate that into an advice, is that even though it might sound for new investors illogical to buy strongly performing stocks, it's actually most of the time those stocks that will continue to do well. So don't buy the cheapest stocks, but buy the best stocks.
Thank you. Shaz?
Hey, am I audible?
Yes.
Hey, Mattias, thank you so much for sharing the information with us, especially those retail investors who are, quite behind or not very financially literate. So just building up on the, things you said earlier in the space. So I am, quite proficient in, financial valuation, but the other side, as you talked about corporate governance, is the side that, we as retail investors especially miss out on those. So what are the, key metrics or, pointers that you use to, to filter out the companies that, these are the metrics that the company should stand out, so that, we can evaluate the corporate governance part? Because, there are a lot of companies on the exchange that, the owners do not want to share the advantages, the dividends perspective with minority one. So what are the key metrics that you look at for corporate governance?
Well, we have our internal evaluation system, which is called Tundra ESG Spectrum, and that's a system. We have 58 measure points in that system. 10 are 0 or 1, basically sector exclusion, so we can ignore those. Then we have 48 remaining evaluation areas, of which half is corporate governance. But it's not a very, very simple answer to explain what you should look for. But I can just tell you that the first area, the first question that we look at is the company's history. How was it founded? Who founded the company? How transparent is its history? And basically, who are the people behind? We do AML screening, KYC screening of all the key people, key management, board members, etc. We speak to local brokers to find out, are there any rumors about these people that we are not aware of? But so it's a lot of that work is qualitative, and which might be hard for smaller investors to undertake. So instead, another key aspect when we assess the corporate governance, and which always needs to be in place, is that if you look at the fundamental performance, say you look at take a textile company, for example. So you have 20 investable textile companies. If you look at the fundamental performance in terms of sales revenue, their margins over time, you will find 5 or 6 of them that are better than the others. That's probably your first selection, their historic deliverance to shareholders. Then you add the component of how the share price has performed, because in share prices you have all these aspects of how well have they treated their minority shareholders. We don't like companies with a very strong fundamental performance in terms of revenues and sales, but where the share price does not match that pattern. So they outperformed other companies on their fundamentals, but they underperformed on the share price. That's a clear warning sign for us. That probably means that you need to dig deeper and understand what it is. So the technical aspects, I think any investor can actually look at the fundamental and look at the share price as performed. But after that, it's just a lot of reading. Read their annual reports, form an opinion, ask people who work with people in the company. Many companies, if you do that exercise, and going back to the example of Interloop, for example, if you ask around people that you know or that you trust and ask them, what do you think about Interloop? What do you think about how they undertake their business? You will be able to found a perception of the company based a lot on common sense. So it's so you can actually do it, but it will require some time from your side.
Shaz, any question?
Yeah, so just another question. So I have seen in your portfolio that you are gradually increasing your exposure in, National Bank in Pakistan over a long period. I do not know if you can answer these questions or not. So basically what I'm trying to understand is, it's a very cheap stock, if you see other metrics like, price to book, multiples. But the key, problem that I have with this stock is, it's state owned, and obviously there are multiple, litigation cases on them, and, they probably do not have, such quality management, just like Mizan or any other beneficial, or I would say any other, interest on that part for the government. But, they are all over the place. Their earnings are, quite flattish, given the, circumstances. So what's your take on that?
I think that's an example where we actually did invest in what we felt was a turnaround case, and which has so far failed. It hasn't been a good investment for us. It's one of the worst investments that we have in the portfolio. I think the logic when we invested in the company in the first place was that we saw the political change with PTI coming to power with a more reform-based program. That meant that the implicit state governance risks that were they're always very high in this company might improve with the new government. The second thing that we concluded was that the pension case litigation in the company is too high discounted. We still feel that way. That when it is solved, we think that the company can go back to the normal payout ratios, which used to be somewhere between 40 to 70% of profits. And if we have a company that is trading at when we invested at around 2 times earnings, and now I think it's around 1 times earnings, I think the dividend yield can be okay. But it is an example of a case where kind of the fundamentals slightly changed along the way. I think that the management changes that we saw a couple of years ago has been good, although there's been some problems there lately. But I think it's still a company that has gone through a lot of problems, which is improving from a very low base, and which I think the share price, I think it was too cheap at 2 times earnings, and I think it's even cheaper at 1 time. But we wouldn't increase in a position until we see that it performs in line with what we expect. So, and the big trigger there will be once they resume dividends. And if you have a company that's trading at 1 times earnings, and it suddenly decides that it's gonna hand out 50% of profits, that can be quite a decent dividend yield. So it's not a case I would promote, but it's still a case that we hold on to.
Abdul, please go ahead.
Yeah, thank you for having me and giving me the opportunity to speak. Am I audible?
Perfect.
Yeah. So, Mattias, I just wanted to ask, like a few years ago, me and my father and our family office, we kind of moved abroad, and a lot of our liquid assets we sold, and we saw that the country risk premium was at 25 to 27%, and it made no sense to be in the country at that time. And we couldn't find a very commercial hedge either at that time. And for remaining illiquid assets that are stuck in the country at the moment as well, we haven't been able to find any solution. So I'm just wondering, how do you hedge your current exposure, whether you run a long short book or whether you short euro bonds or whether you're using currency forwards in any way?
Yes. I might have heard only the first part of the question, but in terms of hedging, the very simple answer is that we don't hedge, but it is part of the investment case that you have the risk of currency depreciation, and you need to adapt your portfolio accordingly. And the reason for why we don't hedge is because it would be too expensive. So if you have interest rates at 20%, and that implicitly means that it would cost you maybe close to 20% to hedge it, and I don't think the currency will continue to depreciate in that pace.
Abdul, did it answer?
Yeah, also I just want to ask a follow-up question that I've been looking at EM and FM returns for the past 2 decades, and of course you've seen the equity market, the American equities resilience in the past 2 decades. So how do you think, like, for frontier markets especially, fare well relatively to the EM markets, around the world?
Well, I think you have a very interesting point here, because if we instead break the last 20 years down to 2 parts, so we had the period, the most recent 10-year period, where the US equity markets have been returned about 15% in US dollars every year. And most of the smaller emerging markets returned low single-digit numbers. So they were quite a boring place, and there were really no reason for foreign investors to bother about them. But if you take the 10 years before that, so say 2001 to 2011, many of the markets, including Pakistan, including Egypt, and a lot of Sri Lanka, etc., these were the best performing equity markets in US dollars over that 10-year period. And I think what changed, there are a lot of things that happened, but I think one very, very important structural factor that has been around for the last 10 years was the ultra low interest rate environment in developed markets. So if you had zero interest rates in well-developed equity markets, that meant that small emerging markets like Pakistan, Bangladesh, etc., they were not only competing head-to-head with the equity markets, but they were also competing with real estate, private equity investments, and a lot of different investment opportunities that arose as a result of the very low interest rate environment. So I think we're entering a period. I'm not that bearish about super high interest rates for a long time because the world simply can't afford it. But I do think that we will have higher interest rate on average for the next 10 years. And I think that means that investors will kind of look back towards the easy growth stories, which emerging markets are. So the first thing they will do is probably look at the big emerging markets, and then you have the smaller emerging markets which follow. So I think that's something that speaks for small emerging markets should probably be a part of any investment portfolio on a 10-year investment horizon from here.
Mattias, I got a related question through message that you are not worried about the interest rates, but some companies may default on the loans. So this non-performing loans may impact the earnings of banks. So how do you see that?
Well, I think in general, the banks or most banks, they haven't been very active on their loan portfolios, but they probably did the smart thing, which is to invest just in kind of almost risk-free assets. We haven't historically seen a lot of a huge share of non-performing loans because the banks have historically been quite cautious in their lending. And no one knows what will happen. And there's, of course, a limit to everything. If you have 100% interest rates and you can have extreme scenarios. But I think in a normal scenario, we're not very concerned that the non-performing loans will be a big issue for the banks.
Thank you. Salahuddin?
Thank you, Khizr Saab. And first of all, I would like to thank Mr. Mattias for, sparing time, especially on a weekend for, the Pakistani audience here. Thank you so much. Well, Mattias, I have a question, we do have some very good companies, as you mentioned, like Interloop and, systems. But the thing is that, we do have some domestic chaos here and challenges. But at the same time, the Silicon Valley Bank default news and, all these type of news coming in. And, these companies have their potential clients and, they are dealing with North American and European markets. So how do you see, once the recession sets in these markets, so it will have an impact. So, how do you see, it's like a double-edged sort of a thing that these companies are facing local chaos, the challenges here domestically, but then if the recession sets in, so how do you see the future outlook for them? Thank you.
Well, I think that you always have the risk of global events happening. We mentioned that in our last monthly letter as well, that of course, if some big major event globally would happen, that's kind of a black swan that we can't really forecast right now. I think if we look at the recession risk, the risks of the US and Europe going into recession, I don't think that's a major impact on our markets because we're so isolated. We're on the margin of deliveries to the developed economies. And we had if we put it this way, we had our own recession in the last since 2018. Basically, it's been very, very hard time for our markets. Most of them have had to adapt. You've seen significant devaluations. We've actually seen the worst period in 30 years in many of the small emerging markets. So I wouldn't say that we're not going to be immune to global events, but I think we're in a better place with lower expectations than what you have in the US, for example. And I think that's something that will support relative performance in the coming years, even if there is a bad route in global equity markets. And simply, again, just because we already took so many hits already, and we're already so depressed and so concerned and so afraid of our own situation.
Awais, Mohammed Awais.
Assalamu alaikum. Hello.
Excellent.
Hi.
Ji.
Hi, Khizr Saab and Matthias. Thanks for conducting this session. So actually, I have three questions. The most asked question in our market is, the effects of currency devaluation. So I wanted to ask, if you look at our markets in the long term horizon, like 10 to 15 years, do you really think that the effect of devaluation erodes in this time horizon? And my second question is,
maybe let's go one by one. Jasir, one by one.
Okay.
Matthias.
Okay.
So, can you hear me now?
Yes.
Yes, excellent. So, I think first of all, it is if you have a high inflation, because interest rates comes from the high inflation, but that also it goes both ways. So basically, if you have so it depends on the company that you run, because if you have an inflation at 20%, that also means that many companies will increase their prices by 20%. So some companies will actually have a positive impact. So that they're going to have more than 20% on the revenue side, and they're going to have less cost increases than the 20%. So it's what high inflation environment and high interest rates, it normally also means that the nominal impact on the business increases as well. So I'm at the end, equities is a real business, and it depends on each company whether you can compensate for the circumstances or not. So there will be winners and losers. So that would be my answer to the first question.
Okay, so the second question is, usually we hear that, to become a successful investor, you need to go against the herd sometimes. So right now, the most hated, you can say, industry is automobile, or the automobile parts industry in Pakistan. So do you think that in such inflationary environment, and when the interest rate is so high, everybody is hating these sectors? So is this the right time that we should take a leap and take positions into these like cement and automobile sectors? So that's the second question. And third third question is also a bit aligned, so I think I should tell it now. I also wanted to ask, should we invest in small to mid-sized companies in PSX, which the funds are not holding? Because sometimes funds only hold companies that have good liquidity. So there are some companies which had strong fundamentals, but they are not that liquid, or funds do not hold them. So do you recommend holding them? And does it affect, are there some pros of holding those type of companies? Thank you.
Yeah, absolutely. So I think the first, if you took two examples of badly hit sectors. We have owned cement companies in the past. It has a growth component in it because you have a need for more infrastructure ahead. That is a sector that we could potentially look at in a case where we feel that the assets are at the too depressed level. Automobile sector, we don't like. We never really liked it. And we think that it's not a very competitive sector. You have... I think the prices of cars in Pakistan has always been too high versus what they can deliver. I didn't really like the quality of the products that they produce. And that means that it's hard for us to see a long-term future in them. Then I'm sure that there will be a lot of opportunities at the end, and we're of course aware that the big swings that these stocks have provided historically. But I don't. We enter a company, I want to feel that this is a company that we are sure we want to own for the next 20 years. And I think that competition in this sector will increase so that the consumers get the better quality for the prices. And that means that it's a little bit hard for us to invest in.
Thank you, Mattias. Kyrgyzstan.
Sorry, you had one more question that's regarding small caps. And I think the situation for us, of course, we have a $200 million fund, and there is a limit to, we have some very liquid positions, but we can only have a very small part of the fund in them. So there are actually a lot of small names in Pakistan that if I had a smaller fund, I would like to own them. So maybe we at some point need to start a microcap frontier fund, because there are a lot of great companies there that unfortunately are too small for us to get the meaningful position in. So I think you should definitely, if you have the interest and the knowledge, you should definitely look at the small caps as well. Just make sure that you're confident with the people who own the company and the management.
Thank you, Mattias. Mattias, I think we are running out of the time, but if you can just give 5 minutes, I will quickly clear 3 more questions and then we'll conclude.
Absolutely.
Awais, please go ahead.
Thank you for allowing me to speak, and it's an honor, and really I will congratulate to the Sarmaaya community to hosting such a beautiful program. Mattias, I would like to ask 2 questions about the 2 companies. Recently, as we are speaking of the export oriented, so how do you see Nishat Mills, which is really undervalued, and it's a very diversified portfolio in the company. Another, I see the Angro Corporation and Angro Group entirely. They have a very good history on payouts. So if you can answer on these 2 topics, it will be really honor for me. Thank you very much for allowing me to speak.
Thank you. Thank you.
Thank you, Ovais. I don't want to, because we haven't done any more extended research on any of these companies in recent years, so I wouldn't be comfortable answering your question on them. So I'm sorry about that.
Sure. Samar, let's go ahead with your last question, if quickly.
Hi, Mattias. I would like to ask about how you guys are managing your you can say like in very low little volatility, and you can say we do not have very much big companies. Like on the fingertips, we can count our company in a PSX. How you guys are managing your risk within this type of market? Like how do you are like managing, and how do you are reducing your risk by every quarter? Like fund used to manage on the quarterly basis. How you guys are managing those risk and volatility? Thank you.
Well, I think that what we normally say is that, which is Pakistan is not alone in this, that all of the markets we invest in, the big issue is liquidity. That means that you cannot always take as big positions as you want to, and you need to keep your positions to a level which you're comfortable of handling. But I think this is a risk you need to take. So you need to, and the way you handle it is that you need to be very, very long term. So you need to take your positions knowing that there might happen things here, which means that we will stick around with these positions for 5 to 10 years. Am I in such a scenario? Am I comfortable with it? So you need to accept that there will be bad times along the way during these 5 to 10 years, and you need to try to find the companies that you think can do decently well regardless. So I'm basically telling you that that you need to ride this risk of sudden negative events which might be unforeseeable for you, and you just need to. That is an added reason why when you enter a company that you should always first start with the quality of the business, because you might be stuck with it for a long time.
Thank you, Mattias. Thank you very much for accepting my invite. Enjoy your trip to France. Enjoy the coffee and macarons at Champs-Élysées, and maybe we speak sometime later.
Excellent. And thank you very much for hosting, Kisa. I think you're doing a great job.
Thank you. Thank you. Really appreciate it. Thank you, everyone. We meet next Saturday. Thank you. Enjoy your weekend. Allah Hafiz.
Bye-bye.
Bye.